everyone. Welcome to my channel, Budget for Success. Woo! My name is Onyx, and you know what time it is. It's Smart Money Tuesday. Woo, woo, Smart Money Tuesday. Oh, you know this is my favorite time of the week, y'all. I know I've been gone for a while, but I'm back because it's Smart Money Tuesday, and it's all the way live in 2025. Yes, yes, yes. Now, let me tell you, 2025 has started with some challenges. Yes, it has. I live in Southern California. I was about 7 miles from the fire. Quite an ordeal. But there's a new day. Today is a new day. And so my heart goes out to all of the families that have lost their homes, who lost loved ones. It's been a really challenging time in the area, but I also know that we're very resilient people. And so there will be a day where we can rebuild. But in the meantime, I extend all heartfelt love and just positive feelings and positive vibes to those who were negatively impacted by the fire. Now, I want to get excited because I got some great information to share with you today, and I don't want to keep you long. So let's get started today. And I want to talk to you about funds versus ETFs. I'm just giving you woo, woo, a highlight. Now, if you want to dig deeper into our discussion, you want to send me an email so we can do some wealth coaching and we can really take a look at how you want to get ready for your retirement, help you connect with the right people, the right financial advisors, etc. But today we're going to talk about what is a mutual fund. We're going to look at some actual retirement examples, and we're also going to talk about ETFs. All right. So, what is your plan for retirement? So, first and foremost, if you do have a job that has a retirement plan, it's going to be tax free if you invest while you are working. So, you want to definitely take advantage of that. You probably go to work every day and you just go, "Oh, I've been so busy. I didn't get to reach out to HR to find out what it takes to sign up." Please take the time. Your retirement is important to you. They will have you keep working and working and working, come to work and go home. And if you never get your retirement started, then they'll always get the service from you because you won't be able to retire. Okay? So take some time to contact HR and find out what it takes to sign up for the retirement plan that they have in place. Some jobs will even match your contribution. Now, if you're self-employed, that's okay. I want you to reach out to your CPA or your banker, your financial advisor, or in worst case scenario, go on Robinhood. They have a retirement account now that you can open. And you can start putting in money in a Roth fund and or a 401k. If you put it in a Roth fund, you're putting it in after tax so that when you get older and you take the money out, you can actually take those funds out without having to pay tax on it. But there are some exceptions, so talk to your tax accountant. But the other option is 401k, where you get to put it in and you get to take a tax deduction. But whatever it is, just start now. If you have nothing, I want you to start doing $25, maybe $100 every time you get paid. Or if you've been doing it and you've been doing, say, a percentage of your pay, it's time to bump it up. Bump it up. 3%, go to 5%. You'll be surprised how you will not miss that money. But either way, let's get started. Let's get it started and here. Yes. All right. So, what are mutual funds? Why would you want to invest in those retirement options they give you when you go to your job and say, okay, I want to start putting money in, and they give you like all these options? You're like, oh my God, how am I pick one? So, mutual funds are pooled assets, right? And they have what's called shareholders. If you invest in it, you become a shareholder. So they're small individual investors that all put their money together, and they can be the funds that you put in can be invested into securities like stocks, bonds, money market instruments, various assets. But they're managed and operated by a professional money manager. So you don't have to know all those things. They do, okay? There will be fees though, because these professional money managers need to get paid. And so fees could be up to 5% of the total investment. If you have a large company that you work for, your fees are probably very small because the company has negotiated those fees down. But you should be aware of what those fees are. So ask those questions. Mutual funds, the portfolio really is structured so that whatever they are focusing on in their prospectus, a prospectus is a document that they issue typically annually, but it says this is what we're specializing in. So you could have a mutual fund that's specializing in tech funds or stocks, or but all in the tech field. Or there could be oil and gas and industry type in mutual fund. Or there could be a mutual fund that says, hey, we're going to follow this S&P 500. So we're going to invest in the top 500 companies on the stock market. I mean, there's different types of mutual funds, and they're centered around different focuses. So the prospectus will tell you what that focus is. If you are working for a company, sometimes they have mutual funds that are geared towards if you have, say, 20 years left to work, then they're going to put a really aggressive portfolio together for you. Versus if you want to retire in 5 years, then the portfolio is going to be more conservative. It's going to have more probably solid returns, but they're small, right? You're going to have smaller returns, but you're not going to have the volatility of some of the mutual funds that go up and down and up and down. And so you want to talk to HR to find out who is managing the mutual fund, and whoever that is should be able to talk to you about what's the best mutual fund for you if you're engaging with your job. If you're doing it on your own, go to your financial advisor and get advice from them. If you're on Robinhood, there's lots of research on Robinhood, so you can research all the options they give you and decide what works best for you. My suggestion is you connect with a financial advisor. So now each shareholder, which is you, gets to participate proportionally in the gains and losses of the fund. So however much you invest, you get a little portion of that return. Or if there's a loss, you get a little portion of that loss, right? So whatever your proportionate investment is, that's what your gain or loss is. And what's really cool about mutual funds is that you will not own more than 5% of your of one company, of a single company in your portfolio. So if you have a mutual fund and it owns only 5% of this company, that company, that company, that company, why is that an advantage? Because if one of those companies goes belly up, no problem. The money manager shifts things around, and you may have sustained a slight loss, but you don't lose everything. Versus if you have all of your money in one particular stock and that stock company goes belly up, you've lost all your funds, you've lost all your money. So if you have your funds in a portfolio, a mixture of assets, then that is helpful because it kind of normalizes the highs and the lows. So you're somewhere in the middle when it comes to your returns. I do have a link here, 10 mutual funds of February 2025. Now, this is Forbes. You can look it up anywhere you would like to look it up, but I just went to Forbes because I wanted to see what did Forbes have to say. And so here are the mutual funds that they've highlighted. Fidelity, Schwab, Dodge, and Cox, which actually I've never heard of. I would have to do some research. Vanguard, I've heard a lot of hubbublub about Vanguard in the just out there in the world right now. Schwab's been around forever. You'll see that these things say like S&P 500 index fund. I've talked to you about that. S&P 500 index funds are good index funds. They look at the top 500 companies that are trading on the market. Many of them are used as benchmarks. So if you want to know if your investment is doing well, let's check what S&P 500 is doing. So Vanguard, Schwab. Now, what's interesting is they're telling you these are the best, but look at some of the returns. Some of them are very low. One is actually a negative. So you go, oh, why would you recommend that? Because this is just a 3-year return. If you have your money invested for 10 years, because you're putting money in for retirement, you should see what those returns on are over 10 years. It could be a totally different story. This is for you to research and look into it. But you definitely want to move forward with looking at your mutual funds that your job offers. Okay? Now, let's move on. Are you on target for retirement? Well, let's check. I found a retirement calculator that you should take a look at. Now, listen, if you're like, Onyx, I'm lost. I don't know what to do. That's okay. No problem. I'll help you. So this is a website. Again, this is provided by Forbes Retirement Calculator. It's kind of cool. You could type in your current age. So you say, I'm 38. I plan to retire at 65. My annual household income is 55,700. I'm just putting a number there. I'm going to save 5% of my income. My current retirement savings, none. I'm just getting started. I expect to have a raise every year of about 2%. I'm going to need 65, let's say we need 85% of my income when I retire. And so, how long will you need that retirement income? Well, if I retire at 65 and we say 35, that should be good, right? I'm 100 years old. So, this is what they will tell you. They're going to look at investment returns of about 6% before you retire, but then you're going to want to put it in more conservative investments while you're retired. So, they're going to assume a 4% rate of return plus inflation, and if you have Social Security. And so what they're saying is your plan provides that you'd have about 200,000 when you retire. And this assumes an annual retirement expense of 79,000, which is 85% of your last year's income. So they're assuming your income grows each year. So your income starts out at 55, but by the time you retire, it'll be at 93,000. So this also includes how much you'd be getting per year for Social Security. So here's your savings for retirement. As you're working, you're adding money, and then boom, 65 hits, and you start spending that money, start spending that money, start spending that money. This is you taking money out. Uh-oh, look at that. Don't think we're going to make it. As it says here, you may need to save more. So that's why this calculator is good. Okay, and so you really want to look at what should you be putting aside. And so it looks like you need to put aside quite a bit to get to your goal of 100. Let's see, what do we need to do to get to our goal of 100? Yeah, boom. So you would want to put aside 16% of your income, and you need to be able to get by with about 55% of your annual income, which means really getting all your debt paid while you're working so that when you're retired, you are hopefully in a location where you can afford it and you have your bills paid, etc. And we can be aggressive on this too. If we did a 5% increase because, you know, we worked a lot, expected income increase 5%. Oh, then you probably need less income, right? 45%. There we go. We could make it. So we would still need to invest about 16% of our income. And you go, gee, golly. Now, 16% maybe you may not be able to invest 16%. If you're a high income employee, there is a cap. There's only so much you can put into retirement tax free. But you could put money into your Roth. Okay. So there's options, but there's also a cap for how much you can put into Roth. Isn't that funny how the world works? They limit how much you can put into retirement. What is that? So you can keep working? That's how the world keeps moving, right? Anyway, look, you go look up this calculator. It's on Forbes website, and you go play around with it and have fun with it. Or you talk to your financial advisor at work, and you start looking at what do I need to be putting aside so that I can really live comfortably? Because that's important. It's very important. All right, let's get back to our presentation. So now, what are ETFs? I am a fan of ETFs. They are exchange traded funds. They're also pooled assets from shareholders, would be that's me, or small individual investors. And an ETF is a basket of securities that you could buy or sell on the stock exchange. So, what was interesting, I found ETFs really began in 1993, really making traction with the introduction of SPY. Everybody's heard of SPY. And that actually became the highest volume ETF in history. And so those ETFs are really great because similar to mutual funds, they invest in a whole conglomerate of companies, not just one company, a bunch of companies. And so if one company goes belly up, your investment could still generate returns if all the other companies in the ETF do well. So definitely ETFs are fun. They typically have less fees, and you can invest in ETFs in Robinhood. You don't have to seek out a financial advisor to invest in ETFs. You could go to Robinhood and look for ETFs. I do have a link here to the top ETFs. So let's share my screen. So these are top best ETFs to buy now. Okay, this website is from Cliplinger. Cliplinger. I don't know whether Cliplinger knows what they're talking about or not. I'm just showing you how you could do some research on your own to look at and find the best ETFs that are out here. So they say that some of the best that are giving the best yields are Vanguard with a 500 index ETF, which means they probably pick 500 companies to invest in. There's a Vanguard dividend appreciation, Vanguard quality factors. So everybody's the talk is Vanguard, right? Is in or iShares. I've invested in iShares as well and did really well with Treasury bonds. Okay, so these are yields that are doing really well, and the cost or their expenses low. But you know what? ETFs are everywhere. You can find all kinds of ETFs. The key is that you take time to research it. I'm here just to educate you. I want you to have knowledge. Knowledge. Knowledge is power. All right. Now we've talked about ETFs. Why do they work? You can buy the stocks of ETFs just like you buy a stock of a company, especially on Robinhood. It has a ticker symbol. They do have to publish their holdings daily. They have to tell you how well they're doing. Because they are traded like stocks, you do have the option of placing orders. You can do limit order, stop loss orders, meaning if they start to lose in value, you can get out. So with a stop loss order, you can say, hey, if the value of it drops to this rate, sell, sell, get out, cut your losses. Got to know when to hold them, know when to fold them, know when to walk away, know when to run. So that's the advantage of having ETFs. You can get out. Settlement dates are usually not settled for 2 days. So once you go ahead and enter the transaction on Robinhood, it looks like it's done, but it actually takes some time before it settles, before you actually get the money, before the money is available, before you can reinvest those funds. Okay. So just FYI, know that when you're dealing with a platform such as, Robinhood. Now, there's so many different types of ETFs, and I'm not going to go into all these. Hey, if you want some wealth coaching, come see about me. Come look me up and we can talk about these in detail. And I can hook you up with a financial advisor that can help give you more information. I just put this information out there because I want you to know about it so that you could seek out and find out what is it that you don't know that you don't know. Okay. There's index ETFs like S&P 500. There's some fixed income ETFs where you're going to get a yield. It may not be a very high yield, but you're going to make money because it's fixed income. So the risk is lower. There's industry ETFs, as I told you, oil, pharmaceuticals, technology, whatever. There's commodity ETFs where you can invest in gold, oil, corn, whatever. There's style ETFs like large cap or small cap. It's just what are you interested in? What is your appeal? And I know you've heard the terms large cap, small cap. Come on, coach with me, and I'll walk you through some of this. Of course, you can invest in foreign markets. Inverse ETFs are interesting. Why would you invest in an inverse ETF? Well, because what happens is if the market is declining, you can make money on it. It's an inverse type of fund where it goes the opposite direction of the market. And that is helpful because in a declining market, you could actually make money. So it helps you if you have a basket of investments. Many of the investments are tied to the market. So if the market's doing well, you're doing well. Great. But if you have this other inverse ETF over here on the side as part of your balanced portfolio, when the market starts to go down, you're still making money. Not a lot, but you're making something. So anyway, hey, check these out. Leverage ETFs are the same kind of concept where you can get returns when things are not doing well. You could actually do well. And then there's obviously actively managed ETFs, which are unlike most ETFs because they really are designed to outperform any index funds like the S&P 500 or NASDAQ. So you definitely want to just research, research, research. What is my desire today? My desire today is that you take some of the information that I've shared with you and you learn even more than what I know. I want you to build generational wealth for you and your family. All right? That's my true desire for you. All right. Now, if you want to get involved with my wealth coaching, I can help you visualize your wealthy future. I will work with you and give you all the tools that I have available to me to help you be successful. So email me at my email address, ojones2012 at icloud.com, and let's get started. Okay? Let's get going. Let's start building generational wealth for our family. Thank you so much for hanging out with me today. I had fun. I hope you learned a little something. I hope that this information, hey, I'm not professing to know it all. This is what I know, and what I know I want to share. So I hope that it really makes a difference. Start taking this information and share it with family members. Take my video and go, hey, listen to her, check her out. She's got something to say. Sometimes people will not listen to you, but they'll listen to other people. So you never know. This video may make a difference for them. They may be inspired to go start their retirement account at their job. You never know what's going to be that thing that clicks. So share my video, please, guys. This is information that I want others to have. Please, please share my video. Let them know that this information is available. They can come back and watch my Smart Money Tuesdays. It's free. It's free information. That's it. My time is up. I love you guys. Have a beautiful, blessed week. be prosperous, and have fun. And if you like this video and you want more Smart Money Tuesday, whoop, whoop, please like, comment, and subscribe to Budget for Success. Love you guys. Bye for now.